Oh, I know.
Tape's rolling, here we go.
You're in the middle? Yes, I'm in the middle. I'm in the middle. Oh, no problem.
Good evening, ladies and gentlemen. Welcome to Reference Point. I'm your host, Dave Cokerhook, and today we're in segment 2 of our discussions of the loan modification process and what impact the current economic environment and specifically dealing with folks who have some challenges relative to their homes and mortgages, what impact that has for you and what it is that you might be able to do. Joining me again are Keisha Woods from EPA CANDO, a nonprofit organization here in the San Francisco Bay Area that's working with people who are having these kinds of challenges, and Narbik Karamian from Arvest Financial, who is in the mortgage lending business, who is actually has been on my show several times, and we've talked about some of these issues in the past. So I want to bring us back to where we ended off in the last segment.
Okay.
In the last segment, we were talking about these hardship letters. I think that was pretty much the last topic we discussed. What people can do if they're in a situation where they are confronted with the fact that they're going to possibly have a foreclosure situation and the process that they can go through in order to help themselves. And actually, I'm gonna make a little diversion here because I didn't welcome you guys back to my show. I've been sitting here, and I apologize for that. So I really appreciate you coming back to do a second segment here.
Well, thank you for having us again.
Thank you for having me.
It's always good to be here. So.
All right, so let's get right into this because we only got 27 and a half minutes here to talk about this, and there's a huge amount of material here. So let's talk about what people can do if they are confronted with this type of a situation, because there are some options that they have.
Right. The first option is to contact your lender. Contact your lender, ask for the loss mitigation department. The regular customer service department cannot help you with this. So contact the loss mitigation department and ask them what's the process. Ask them what's their process in obtaining a loan modification.
So each bank will have a different process?
Yes, yes. Each bank will have a different process. Each bank has it's called the financial worksheet, but it's like an application. Ask them what's the time frame. Loan modifications normally take 45 to 90 days. Some take longer. It just depends on the lender.
Okay.
And the investor.
All right.
And I wanted to say about the investor, with a loan, when you get your loan modified, you might, even though you're with Wells Fargo, or you might have your loan with a Washington Mutual, they do not have the final say-so on if your loan is modified or not.
Oh, really?
Right.
Right.
Why is that?
Well, these loans are sold. They're sold to a pool of investors.
Oh.
And the loan has to get approved by the investor. The modification has to get approved by the investor.
Interesting. So if I had a loan that I got through Washington Mutual,
Right.
for instance, and I go back to Washington Mutual to discuss with them if they can help me facilitate a loan modification, they are not the final say-so anymore.
No.
If I may, the investors are the ones who provide the funding.
Sure.
In this case, the banks are the servicers for the investors. So they're the middle people initiating contact with the borrower. So they take all the information. The investors have provided the bank that, you know what, if a client or if a homeowner has these certain criteria, we'll be willing to modify. They take this information, but as Keisha said, the investor has to sign off.
Well, who are the investors these days? Is this like Fannie Mae and Freddie Mac?
No.
Because didn't they buy up a lot of the loans? But that's a different
Some of them
thing.
may be Fannie and Freddie. Most of the loans that are under $417,000 might be Fannie Mae and Freddie Mac. If not, at least the investors may have already sold them, because these loans may have changed hands 4 or 5 times. And I'll give you an example. There was somebody I read, I can't remember where it was, who had not made the payment for 3 years.
Wow.
And he was still in his house, in their home, and no foreclosure process had been initiated because they couldn't find the investor
who actually owned that
them.
loan, because it
So
was
there was one lucky person over there.
I guess. Now, Keisha, you were telling me that your organization and other organizations like yours are offering workshops for homeowners who are confronted with some of these challenges. Is that correct?
Yes, we partner with lenders. Currently, we're partnering with Citibank, Wells Fargo, Washington Mutual, IndyMac Federal Bank, and we put on hands-on workshops. So the last workshop we had was in Daly City, and we gave a presentation. The presentation included the foreclosure process, legal issues regarding foreclosure, budgeting, and just the modification process, different types of options that are available for you. And after the presentation is about 45 minutes. After the presentation, the lenders that are participating, they will sit down and talk to the consumer one-on-one.
All right. Well, you mentioned several things here. You mentioned the foreclosure process, you mentioned budgeting, you mentioned the understanding who your lender is and things like that. So let's talk about some of these things. The foreclosure process, I think, is something that people hopefully never have to deal with. But if you're confronted with it, if you don't understand it, I think you are at a disadvantage.
Correct.
Fairly stated?
Correct.
Now, if I may, one thing I want to add, the foreclosure process itself is one of the last processes involved in losing a home. There are quite a lot of steps prior to that. And this is something that, so when we talk about foreclosure, that's like the final
That's
strike.
the last.
Right.
Okay,
So I
so
think there's
what are some of the things that we'll get to that eventually?
Exactly.
Then let's talk about some of the earlier actions that a homeowner can take to avoid reaching the foreclosure process. Then I guess, where are we on that, and what can people do?
Well, in Silicon Valley, due to the fact that borrowers bought their loans with not verifying income, first they need to sit down and develop a budget. That's really key, and really sit down and see how much income and how much house can I afford. That's the first thing. How much house can you afford?
Even though you may already be in a house, truly, can you afford the house that you're in?
Can you afford this house,
Okay.
especially if you have a negative amortization loan? Because the reality in the industry, we call those like liar loans, because you're not paying on your principal and you're not paying no interest.
Right.
But in today's market, that loan has been eliminated, and if you do receive a modification, you are going to have to pay on the principal and you are going to have to pay interest. So you really do need to sit down and evaluate your financial circumstances.
When you say that loan has been eliminated, that doesn't mean that you're no longer stuck with the loan that you took out 2 years ago. That means that you can't expect to refinance your house under the same kinds of conditions. Is that what that
And
means?
new borrowers, new people who want to buy new
people who are
homes
buying a new
will
home
not
for
be.
the first time, you can't get that kind of a loan.
So it's a reality check now.
Yeah.
You know, it's
Okay. All right, so work out the budget, figure and determine whether you really truly can afford this house or not. And if you come to the conclusion that you can't, what do you do?
If you come to the conclusion that you cannot afford this home, you need to find a real estate professional in your area. Contact them, figure out how much your house is worth. And in today's market with declining values, you might have to have a short sale. If you do have to have a short sale, a nonprofit agency like ours can help you with the short sale process, or a realtor. You have to ask the lender if they will take less than what's owed. And that's called a short sale. A short sale is when you owe $500,000 on the house, and then the house is only worth $350 or $400. The lender's taking less than what's owed.
So you sell it for the $400 and they'll say, okay, fine, we'll write off that $100.
And you also need to find out, if that happens, what are the consequences of that? With equity, a lot of consumers have first and seconds on their house.
Right.
It's important to know that when you have a second and you do a short sale, that second still might be owed even after you sell the house. So you could literally not have the house no more and still have to pay on this loan.
Okay, let me see if I can put that into context. So originally when I bought the house, I bought it for $400,000. Okay. And then it appreciated, and I'm thinking, this is good stuff here. I'm going to take out a second. I can take out another $50,000 in the second mortgage. So now I've got $450,000 or whatever, let's say $450,000 in mortgage on my home, okay? And the home depreciates. I can go back to potentially, I can go back to the owner of the first that took out the mortgage initially and say, will you accept a short sell? And if they say yeah, then that $400,000 may be able to sell it, and if I have to sell it for $3,000, I'm okay. But I may still get stuck with that extra $50,000, is what you're saying.
Unless the second lender is willing to give you the okay to move forward with the short sale.
Oh, do they have to okay it initially?
Both parties have to
okay
okay
it initially.
So what?
Oh.
So what happens is, obviously, we know that the biggest loss is going to be on the second holder, and that's why usually second liens are at a higher interest rate because the risk factor is higher. But what happens is the first lender pays the second lender a lump sum, not that much, for them to either take this little amount or just, let the house go into foreclosure, which in that case the second does not even get anything towards it.
Okay. So here we are. We're looking at some of these things that you can do before you end up in the foreclosure situation. We talked about doing a budget and figuring out whether you really can afford this house, and if you determine that you cannot afford this house, then you should go and speak to your realtor. Speak to a realtor, see whether or not the owners of the mortgage are going to be accepting of a short sale. What else is there between then and foreclosure?
Now, I'd like to tag along something, a little tip to the public in terms of short sales. Until 2007, when you did a short sale, the difference that the lender lost would be actually you would have to pay taxes on.
You would have to pay taxes on
but
that?
come actually January of 2008, this law was eliminated.
Oh, okay.
So even if the lender were to lose 200,000 or whatnot, you would not be liable for any kind of a tax.
It doesn't have to show like I made some income and therefore have to pay taxes. So that Uncle Sam is not taking some dollars out of your pocket. Go figure.
Right. So
Uncle Sam.
that's really important. So a lot of consumers should take advantage of it because it's only temporary, correct?
Right.
It's only temporary. So it is due to expire 2009, correct?
Again, I know it's gonna, but I'm not sure where because
right now, the short sell is a viable option for people, and there are advantages to it if you find yourself are able to take that step. Okay.
Because a lot of people didn't like to do it because they had to pay taxes on it.
And that makes sense too. Okay, so we got the short sell as an option before you end up with foreclosure. What are my other options?
Other option would be a repayment plan, and a repayment plan is where they would give you, most banks would give you up to 6 months to pay the arrears, and they'd take your arrears and divide them over 6 months and tag it along to your regular payment.
So if I haven't made a payment for 4 or 5 months or 6 months or whatever, and my payment was $2,000, let's say it's 5 months, I can do the math on 2,000 times 5. That's 10 grand, and I'm in arrears $10,000. You're suggesting that they'll take some portion of that and add it to what the monthly payment should have been so that I can eventually catch up and okay.
That or also they add it to the principal balance and they actually set you up on a payment program based on the new balance.
Oh, okay.
So it again, as Keisha said, it varies from lender to lender because it's new territory for them.
Right.
They don't know, quite frankly, what guidelines to follow.
And another option is a great option is the special forbearance. So special forbearance is when the consumer is still in the hardship. So and lenders normally do this if you cannot prove that you are able to afford your house currently at the note that it is. So they will reduce the payment for like 6 months, and they would add the difference onto the principal balance. So
they give you a negative amortization.
Yeah, exactly. It's a negative amortization loan, but it's for the consumer, so you can still be paying during your hardship, and then after your hardship, normally they'll tell you we'll convert it into a modification. Normally they say we'll do it for 3 months, like a trial period, and then we'll convert it.
One of the things that comes to mind to me when we're talking about this, and I realize this whole area is new territory for everyone.
Correct.
And so these guidelines that each bank is putting out for what they might do in a loan modification, etc. The ground rules, though, are changing daily when it comes to whether or not people are going to have a job tomorrow. Okay, right. So if they've got programs that are structured along the lines of the forbearance program or whatever else, this assumption is going to be they're going to be able to make payments on these things eventually because they still have a job. But when you have an environment that's as tenuous as ours is right now, what are either the banks or the federal government or anybody or in California, the California government, looking at to try to take this into consideration and be positive and proactive in this area?
As the unemployment rate's going up, it's hard to predict how the banks and the federal government's going to react to this. Right. And as you mentioned, these guidelines are changing because the more money the investors, and I can refer this back to 2007. no bank was willing to compromise over a short sale, because they were still thinking that no, if we keep pressuring the homeowner, they will make the payments. Now they're at the point where they're happy at $100,000 loss. Okay, now we don't know what's going to happen. Just like the way the Treasury came and said, okay, we're going to implement $700 billion and we're going to go in and back all the buy all these mortgage-backed securities. This is what we're talking about. But then the plan changed. All of a sudden, instead of backing the mortgage-backed securities, they ended up, giving money to the big banks to buy their competition and forget about the mass public here. So things are changing a lot, but it's just a matter of taking advantage of what's available now before it's too late, because we don't know. It might get better. It might get worse.
Right. All right. So we've got the budget, the assessment, whether I can or can't. We've gone to our lender to see if they will work with us. Is there anything else available before the foreclosure problem starts to really confront me?
Some individuals may need to seek for legal counsel. They may need to if they do decide to have a short sale, or if they do decide to just let the house foreclose, just depending on their individual situation and what their future plans are. So just be aware of what's ahead of you. I think that's the main thing that I would like to tell people. Just be aware and be knowledgeable about all the options that you are taking. And then if you do take a loan modification, too, be aware that you do sign over some of your rights when you take a loan modification.
What does that mean?
Well, that means that the bank, if you have a loan modification, I have seen consumers that have received a loan modification, and for whatever reason their situation may have changed and they missed that payment on that loan modification, the lender could start they don't have to start the foreclosure process over again. If you are in foreclosure, they can
just take it right back to where it was. Okay.
Right back.
But you had one of the things that you had mentioned to me before the show was that when you look at, we have a graphic up here that identifies the foreclosure process here in the state of California, and you had mentioned that if you're in this continuum someplace and you do begin to initiate the communication about a loan modification, that you have they don't necessarily continue on at that point. Is that correct? How does that work?
It's frozen.
It's frozen
until the point you get the answer. If it's approved, then you enter a new chapter of making mortgage payments. But if it's denied, as Keisha said, they can go back and start counting from the first day you made your default payment.
Okay. All right. So let's talk about this chart. What are the significant points in this chart that people need to understand?
Well, time is of the essence. I'm a realtor, so I love that phrase, time is of the essence. So when you do receive a notice of default, that's day one. The foreclosure process is normally about 120 days. Some lenders right now, I have seen lenders not file a notice of default when people are 9 months behind. So it just depends on the lender. But once you do get that notice of default, please pay attention. By law, the Senate did pass a law, Senate Bill 1137, where the lender has to give you a 30-day notice, and they have to give you a referral to a counseling agency so you can have a third party to help you mitigate this.
This is the California Senate you're talking about?
Yes,
okay.
yes. So that has in the 30-day notice. The 30-day notice has kind of slowed the foreclosure process along. So right now you have a lot of people in foreclosure that necessarily have been halted because of this, and it's kind of slowed it down a little. But I do predict in coming 2009-10 that you're going to see more foreclosures, because 2008 they were kind of backed up. They were holding them off.
Now they're going to.
Yes.
Okay. All right. So it's once you get into that situation, it can be a challenge, right? It's not
right.
Something that I saw this on the internet. I think it was just yesterday, and I think I mentioned it before the show. And that is that there's discussion in the U.S. Congress about passing a law that would allow a homeowner to put their mortgage into their bankruptcy situation and try to get and have the judge change the terms of the loan or whatever. Is this realistic? I mean, do we anticipate that something like this might actually occur? And if it does, what is the advantage to the homeowner?
Well, the bankruptcy law changed a couple of years ago, and I remember the following there that was going to change. There was a long line at the courthouse. People were filing for bankruptcy. But ultimately, right now, what's obvious is that the federal government is taking every step it can to make the foreclosure process avoidable as much as they can. Now, one of these things, as you mentioned, is if somebody were to file for bankruptcy, they're considering giving the bankruptcy person or the person who's filing for bankruptcy to at least hang on to their home. So these are things that are things being worked on. Our legal department would know better. I'm not very familiar with this,
and there isn't anything that's certain on that. But
one thing I want to mention, and I'm sure Keisha will agree, is no matter where we are in the foreclosure process or in this default being late, it's very critical that you communicate with your bank on a constant basis. They want to hear from the homeowner. That just, if they're going to work with you, I think that's going to open up a lot more room than ignoring their calls.
Right.
I want to talk a little bit more about that again, and where they should communicate within a bank, etc., and how they should go about with that communication. But I want to remind our viewers at home that if they have any questions about the content of this show, the last episode we had, please send us an email at info@referencepointtv.com. As I mentioned, we have a full list in the Bay Area and in the state of California, of nonprofit organizations that can assist you if you are confronted with a loan modification demand or need or foreclosure situation or whatever. So please let us know if you have any issues or questions, and we'll be happy to do what we can. So now let's go back to this subject of communication to the banks. You had mentioned there's typically a department in the bank that is there that knows enough about what's going on actually to help out. You don't just walk into your local branch and say, hey, I got a problem.
No, the local branch can't help you. They could, in the customer service, the collections department, they can't help you either. You have to ask, if you're not in foreclosure, you ask for the early loss mitigation department.
The early loss mitigation
loss mitigation department. Each bank is different, but they do separate them. You have an early loss mitigation department, you have a foreclosure department, and then you have a loss mitigation department.
So three different teams of people or departments within the overall bank that will address things depending upon where it is in the cycle.
Right, and in California, most of these departments are not located in Northern California. They're East Coast and down south. So you literally cannot walk into the bank to get this done. And most of the employees at the bank don't know nothing about foreclosure and loss mitigation. So it's really
so if I call my branch and I say I'd like to speak to someone in the loss mitigation, the advanced loss, the early loss mitigation department, are they going to know what I'm talking about?
They should.
The reason we say that is because it's a totally new department.
Right.
Sure.
This didn't used to exist. Loss mitigation used to be there, and they were the ones who would do the final evaluation of the loan to make sure that it was a secured loan. But all these departments are new. So these people who were working there were hired in 2007 and 2008.
Right.
And the amount of time it takes them to be trained and be ready to actually execute, they might be hands-on maybe, very recently.
Right. But if I come to you or an organization like yours, you can counsel me to say, your loan is with who? Washington Mutual. Okay, you should speak to the loss mitigation department. Here's a phone number.
Well,
or do you do that for people?
We do that for you. The nonprofits do have because we're part of the Hope Now Alliance. So we do have a special set of phone numbers that we use to contact the lenders for nonprofits and for the counselors.
Oh, okay, great.
So we do have kind of more of I don't want to say a direct approach, but we're able to try to make the contact and see it, try to navigate this for you.
So we're running out of time here again. Yeah, go figure. And I think it might be useful just to do a little quick summarization here. I think one of the real key points for people is because of organizations like yours now, Keisha, they're not in this alone. Okay, there is a resource that you can go to if you're confronted with a problem, either as the subprime mortgage that you're trying to deal with, or if it's a pay option arm that you're trying to deal with, if you're looking at the fact that you may have to default because you've lost your job or whatever it happens to be, that there are places that you can go now with people who understand the environment, understand the challenges, and know what it is that you may be able to do to try to resolve your problem. That doesn't guarantee that you're going to get out of the problem.
No, but you'll be surprised on how many options there are
Right.
that you may not be aware of.
And I think that's a key thing. You know, there's so much talk in the news about, oh, it's this and it's that, and depreciation of the homes and foreclosures and blah, blah, blah. And so you get this doom and gloom situation constantly. But the reality is that there are some things that you can do to protect yourself and to get through it and be okay on the other end. Fair enough? The first statement?
Fair. And I think to me, the most important thing that a nonprofit, even a realtor, provides is someone to kind of hold your hand through the process. Because this is, if you've never been through this process, it's an unsettling situation.
Yes.
And I have seen people get sick, can't sleep.
Oh yeah, sure.
So
stress has got to be
it's a stressful process, and a lot of families, the kids are affected, the communities are affected, school districts have been affected, loss of funding, blight in communities due to high foreclosure rates. So it's something that we all need to just kind of pay attention to. And if we see or know somebody that you may feel that's having trouble paying the mortgage note, if you could refer them over to a nonprofit agency, I think that would help a lot.
And there are in the Greater Bay Area, yours is in East Palo Alto. There are facilities in Oakland, Pittsburgh, Richmond, San Francisco, San Jose, Sunnyvale, over across the hill in Watsonville, some out in the valley, and Stockton, Fresno, places like that. So folks, recognize that there are possibilities for you, and that go to the nonprofits. That's probably a key thing, because they're not going to charge you to do this, and they know what it is that you can do to try to resolve your situation. And working through them, I think you'll probably get much more receptivity from the banks as well, because they know why you're there and what they can do for you. So, Narbik, Keisha, thank you so much for coming and sharing your wisdom and knowledge with us here at Reference Point. I hope you folks out there in the viewing audience have learned something here. Remember, if you have any issues or questions, send us that email at info@referencepoint.com, and we'll do what we can to help get your questions answered. So again, thank you for being here.
Our pleasure.
And you folks in the viewing audience, we'll see you next time on Reference Point.